Okay, we are going to talk about the loan analytics. So loan is a very important contract and transaction in the capital market. So we talk about the loan analytics, and then we talk about, like, we still follow the flow we discussed earlier. We talk about the data structure of the loans and data structure loan contract, and what kind of information we can get from a loan contract. How can we help lenders? How can we help borrowers? So these are the same pattern we discussed using the 10K, 8K, the pattern and analyst data. So we will discuss the structure of the loan data, and we also talk about how we use the data to help creditors and the borrowers. So this is the figure to explain what's a loan, how to define a syndicated loan. So so basically, so let's say Microsoft want to borrow $200 million loan. So let's say some of you guys want to borrow money from me. Let's say Zerlin want to borrow $200 from me. $200 is okay. I can lend to Zerlin. Should be travel, but the $200 million, that's huge. So what do people do is that a lot of creditors, they will bundle together to lend the money to the Microsoft. So the leader will be called the lead arranger. So lead arranger is the person who are arranging this loan. So basically, if I'm the leader arrange, I will make several phone calls. I will call my friend. I will call Connie. I will call Shirley. I will call Yiheng. I will call Tong He. I will call you guys saying, hey, come on, we have a friend. He wants to borrow $200 million. I only have like a $10. Do you guys have like a rest of them? And so kind of I make the phone call. The lead arrangers make the phone call to arrange the rest of the lenders to together bundly provide the money to the Microsoft. So this is called a syndicated loan. So why you want to do that? Because the risk, because this is too much. If the lead arranger take the whole 200 million loan amount, you will make the lead arranger bankrupt. There's too much money for them. So you can diversify the risk. And there's a lot of good things happened when doing a syndicated loan. So so basically that's the idea here. Normally we broke the loan into pieces and sold it to lenders. So it's like the example I said. Make a phone call to a couple of friends, and we chip in together. And help Zerlin. Zerlin need help, so we all chip in to help Zerlin. The lead arranger make a phone call, make an arrangement, and the syndicated remainders are the people who kind of hold the $100 million here. So these are the syndicated loan case, and we'll talk about some ideas. What is revolvers? What is term loan? This is a very important concept you guys should learn as a finance major, and you should do data analytics on this concept as well. And so revolvers is like a credit card, like the Microsoft want you $200 million credit card. If they don't use it, the money will sit there. If they use it, they can use it anytime. This is the revolver. So what is term loan? Term loan basically it's like the Microsoft get the $200 million cash on hand, and then they pay back periodically, 1 year, 2 years, 3 years. So these are the two different types of arrangement. Yeah, revolver is like a credit card. Like they use it only if they want. Like when you guys use credit card, if you have a credit card. So yeah, so it's like a revolver. Term loan is like you get the money in the pocket and you pay back periodically. That's the term loan. So I will explain the idea of a floating rate. I will explain what's the tenor, the duration, and also talk about some covenant. So what does covenant mean is, covenant means when I want lend money to Zerlin, I have a condition. So I say, Zerlin, you need to get A from this class. Otherwise, I will take my money back. So that's called a covenant. Let's get a covenant. In the same for the bank. Bank will tell Microsoft, your earnings has to hit $10. Otherwise, I will take my money back. So these conditions, contingency, it's called a covenant. It's called a covenant. So in a loan contract, you need to understand all these institutional background. So that's what I'm saying. In order to do data analytics, it's not about programming. It's not about Python. It's not about SAS. It's about understanding of this background. If you can understand this background, you can easily get the data insights out, get the pattern out. That's why I was talking to you guys. The data structure and the structure of the data goes #1 for business analytics. If you only know Python, if you only know SAS and the data, I don't think that will fly. I don't think that will fly. I think if you understand the structure of the data, if you understand the loan contract, the institution background, it's much easier for you to get the data pattern from the contract versus the computer science major. When they look at this, they don't know where to start. They don't know where to start. So coming back, what's covenant? Covenant is the contingency on the loan contract. So basically, the company has to hit certain performance in order to maintain the cash. So this is the syndicated loan. This is people work together to provide the loans. And we have the revolvers, term loans, and we have the floating rate. I will explain floating rate, and also I explain the covenants as well. I will explain covenants as well. So let's look at the data. Okay, this is the background. Let's look at the data, data structure. So I already explained the revolvers and the term loans. So behave like a credit cards, right? Behave credit cards. Term loans is behave like a mortgage. Mortgage. Have you guys? I don't know if you guys purchased the house. Maybe not yet. When you guys purchase the house, you need to get the loan to buy the house, and then you pay back the loan. So it's like term loan. That's kind of term loan, and so you can see that. So you can see that the percentage of this, you can see the revolvers. You can say you can borrow, repay, borrow, repay, borrow, repay. You can see for the credit card, that's how it works, right? You use the credit card, you pay back, credit card, pay back. This is the revolvers. And for the term loans, you can see that. Yeah, you can see that you borrow money and pay back, and so one behave like a credit cards, another one behave like a mortgage, and installments. So installments means you pay your payments in a periodical way. That's called the installments. Okay, this is just terminology you should be able to understand. Okay, let's just look at what is a floating rate. Floating rate is so this is LIBOR. You guys must be familiar with LIBOR. LIBOR is the U.S. determined inflation and rate. So this is the rate determined by the government. So what is floating? Floating means whatever the government determined the inflation rate is, you add up some basis points on the basis point. That's called floating. So this is so what's the option here? You have two options. One option is the interest rate is 7% fixed, regardless how the inflation rate changes. 7% interest rate. But most of the time it's not. Most of the time, when we call the floating means whatever the inflation rate is, you add the 300 basis point on the floating on the inflation rate. That is called a floating. That is called a floating, and so basic rate, because you don't determine the base rate. Who decide the base rate? The London the government, the prime, the Europe and the US government determine the base rate. So so basically, as base rate varies, your interest will change. So if the base rates rise, your rate will rise. If the base rates go down, your rate will go down. So that's called floating. That's called floating. So that's also that's also choice. You guys want to buy a house. That's also when you buy a house, you get a mortgage. They also give you two options. One is floating, one is fixed. Floating means whatever the government base rate is, you add 300 basis points, 3% on the base point. That's floating. Fixed is, I would say, I'm 7%. Regardless how base rate changes, I just pay 7% for the interest rate. So most of the time is floating. Most of the time is floating. And this is how interest rate is determined. Okay, this is how loan interest rate is determined. The reason I want to explain this is because if you don't understand this, how can you do data analytics? So in order to do so like earnings, if you don't understand what is earnings, how can you do a data analytics on earnings? If you don't understand asset growth, what is asset growth? How can you do data analytics on asset growth? This is, I want you guys to provide the institutional background on this information. I want to explain the structure of the data. That's number one. After I explain the structure of the data, and then you can tell me how you can use the data to help lenders and help borrowers. Okay, this is about the syndicated loan. So far, you can see that we talk about talk about the lead arrangers. We talk about the revolvers, term loans. We talk about the floating rate. So basically, floating rate is base rates varies, interest varies. So this is the idea. So this is another concept. This is another concept you need to know. So what is facility? What is package? This is also terminology you need to understand. So basically, so let's say so $2.5 billion loan. So among the $205 billion loan, the composition is $1.5 billion is a revolving loan, and $2 million is term loan, another revolving loan. So in that case, what does this mean? That means the whole loan can be broken down into two different deals. One deal is 1.5 billion, 5-year deal. Another one is $2 billion, 364 days deal. So in that case, each deal it's a facility, and you add this together, it's called a package. It's called a package. So that's how when you work in the bank, people always talk about this is a loan package. This is a facility. That doesn't mean is package main contains different facility. Each facility is a deal. So in this case, the $3.5 billion package contains two deals. The first deal is $1.5 billion revolving deal. Another one is $2 billion, 364 revolving deal. So each deal is called a facility. Each deal is called a facility. This is terminology. You guys, like I said, if you don't understand the data structure, how can you analyze the loan contract, right? So this is a very important data for finance accounting major, because you see how much bank is lending out every year. Huge. So you have to understand the bank loans. You have to understand the bond market. How to understand the loan? How to understand the bank market? You need to data. You need to understand this data. You need to do all the loan contract data in order to understand those loan contract. So that's what I'm talking about. Okay, that's what I'm talking about. So the example here is we have a $2.5 billion loan package. This is called a package. And under the package, there are two deals. The first deal is $1.5 billion deal. Another one is $2 billion deal. Each deal is called a facility. It's called a facility. That's why we have a figure here. The whole package has two deals. One is orange, another is blue. So this is the data structure for the loan contract. So this is a loan. So deal for the loan contract. And let's look at so this is the example. Do you guys remember when we talk about the item, when we talk about AK, we said all the loan contract is in the item 1.01. All the loan contract in item 1.1. This is the example we talk about in the previous class. And in the video as well. So what we have here is in AK, the firm has to disclose their loan contract in item 1.01. So looking at what we have here, this is the summary of the loan. So the loan is about $2 billion. It's about 2 years. It's about floating and used for working capital. So this is a summary of the loan. How do you get exactly the details of the loan contract? You have to go to the exhibit 10.01. 10.01. Okay, so this is how the data, the loan contract data, you look like. When you go to the SEC EDGAR, you see the summary of the loan. You get the loan amount, you get the 2 years, you get the floating, you get the loan is used for working capital, you get the summary of the loan. But how do you get the details of the loan? You go to the exhibit 10.01. Let's look at 10.01. This is so, no, this is different. So if you go to the exhibit 10.01, you can get the details of the loan contract. The loan contract has everything, has all the details, all the covenants, all the leader arrangers. So everything, every details is in the loan contract. So personally, I have processed many textual data. I have processed annual report. I have processed a lot of textual conference call. The loan contract data is one of the most difficult textual data we can handle, because the loan contract data has a lot of terminology, difficult terminology, and has a lot of legal terminology. So it's like you need a kind of, I feel like I need a lawyer to understand the loan contract. So this is very complicated data to process the loan contract. But at least you guys should know there's a data there, and you can analyze the data, and the data has what kind of information the data has, and what kind of information you can extract from data. So this is something I want you guys to keep in mind. I want you guys to keep in mind what kind of data you have from the loan contract. So again, one more time, you have to make the unstructured data structured. Do you guys remember what talk about the patterns? The pattern data was unstructured. We make it structured. Here, the exhibit 1.01 is unstructured. We have to make the unstructured data structured. Once you make the unstructured structured, and then you can do the analytics on the data. This is the structured data. Okay. Once you get the loan contract, complicated loan contract, you can structuralize unstructured loan contract into structured way. So here you have the company name, you have the facility, you have the package. I want to just repeat, each package will have multiple facility. Okay, each package will have multiple facility. So this is how the data structure. So going back, what I'm trying to say here is from the SEC EDGAR, you can get the summary of the loans, but that's not enough. So you have to go to the exhibit to get the complete loan contract. Complete loan contract is unstructured format. How to make the unstructured format structured, like what we did in the project 5. You can use the regular expression to make the unstructured format structured. Once you structuralize the unstructured loan contract, you have all these structured data. So like this. And like I said, one company will have multiple package. Each package will have multiple facility. That's how the data structured after you have done that. So this is the this is about the loan contract. This is about loan contract. So let's look more about this loan data. One thing I want to point out is what I can use this for loan data for. I explained so much. I explained the lead arranger. I explained the floating rate. I explained the revolvers and the term loans. I explained the unstructured structure. I explained so much information about loan contract. So what exactly you can use the loan contract for? Okay, you can use the loan contract for data analytics for two type of people. three type of people. The first one is creditors. Okay, creditors. So banks. You can tell bank whether this is the efficient loan contract for bank, right? Like an example I gave to you guys. Like if I want to put a covenant, I would tell Zerlin, you get an A, you can keep the money. You don't get an A, you return the money. So how to determine this condition? Should it be the A or A minus or B? Or it should be a grade, or should I put on the condition on the project 1 or project 2, or is overall grade? These are all decisions bank has to make. These are all decisions bank has to make. So how bank can make these decisions? They will rely on you guys. You guys can do the data analytics on the loan contract, and you guys can figure out what's the efficient contract, what's not efficient contract. So you can tell your bank managers, you can tell them, here should be the way to contract this. We should tell Zerlin should conditional on the project 2 and the project 4, because Zerlin he's pretty good at project 1 and 3. So we don't need to condition on 1 and 3. We should condition Zerlin on the 2 and 4. And then we should say we want Zerlin to talk more in the class. So the international contribution may be another condition to put. So what I'm saying is, by doing the data analytics, you are helping bank loan managers to help them to determine what's the best loan contract for them. What's the loan platform? What's the best covenants? Should I do floating or do I do fixed? Should I do what loan amount they should lend out? How to determine the interest rate? Is the interest rate? So let's say if I lend money to Haixin, maybe Haixin is a very nice person. Maybe I want to lower my interest, but how exactly, how much should I lower? All this has to be done using the data analytics. So we can use loan contract to do a lot of things. We can serve bank loan managers. Who else we can help? We can use the loan managers. We can use the loan managers, loan data to help borrowers as well. So basically, so Microsoft want to borrow $200 billion. You can help Microsoft for the contracting as well. So that's another way to help. The third way is what? You can help Microsoft investors. So what do I mean? If Microsoft is borrowing money, what does that mean? That means Microsoft is doing well in the future or doing worse in the future. What does that mean? So by analyze the loan contract of Microsoft, you can also help Microsoft investor to tell Microsoft investor whether they should invest in Microsoft now or in the future. So basically what I'm trying to say here is the loan contract information is very powerful. It's very powerful. It's complicated, but as well as powerful. You can use the loan contract information to help bank managers for efficient contracting and monitoring. Why I say monitoring is the bank has to make sure Microsoft can pay back. So by analyzing this data, you can help managers to get a better loan contract, also to help bank managers to monitor Microsoft to be able to pay them back. And that's number one, people benefited from loan analytics. The second type of people are Microsoft borrowers. How should Microsoft borrow? How much they should borrow? What's the interest rate? So Microsoft can also benefit from your loan analytics. The third group is the investors of Microsoft. When Microsoft have a loan contract, if the interest is very low, what does that mean? That means if Microsoft can borrow money at a very low interest rate, that gives a signal to investors. Microsoft is doing very well. It's doing very well. If I'm an investor, I will invest in Microsoft. If Microsoft can get a deal from bank, that means the Microsoft is doing very well for the future projects and in the past. So these are the signals to investors of Microsoft. So I'm keeping repeating this back and forth. Back and forth. I'm keeping saying this back and forth. So what I want you guys to understand understand the structure of the loan data. I'm sure right now you can get the sense what's the structure of loan data. You have the little sense about that, right? And also I want you to have the sense what's the data should be used for. I said three group of people. You can do the analytics for banks, creditors. You can use data analytics for Microsoft. You can use data analytics for Microsoft investors, send signals. to investors. So these are the very powerful data you should analyze when you guys work for hedge funds, work for the brokers. Again, use the example when your boss asks you to do some analytics. This is data you should rely on. I said loan data is very complicated, but at the same time, it's rewarding. It's rewarding. You can get a lot of information from that. So this is something you guys keep in mind. In our project, I only want you guys to do balance sheet, income statement, and annual report. I even take out the annual report project for you because I know I don't want to have you guys overwhelmed. But I want to present all these available options here after the semester, after the class. This is something you will use in your real job. So this is, I want you guys to pay attention to, even if this is not in your project, but this is very similar to the way you analyze balance sheet and income statement. Okay, keep this in mind. It will help your future understanding of the capital market. So I want to also talk about different type of loans. So we have investment grade loan market and we have leverage loan market. So what's the difference between the two types of loans? It's risky. So this one, if Microsoft is rated very, very safely, then this is investment grade loan. If some company is very risky, some companies is very risky, then it will be leveraged loan market. So basically, we divide the loan market into two segments. One is safe loan, another one is risky loan. So you just make sure when you analyze this loan, you can help your boss saying, should we invest in a safe loan or risky loan? These are all decisions you need to make using the data analytics, right? You can invest in a safe loan. Microsoft probably will be a safe loan. Microsoft, the loan rating should be above BBB minus. Some risky company maybe just risky. They will have a higher interest rate, right? The higher interest rate. So this is a safe loan and a risky loan. So this is two segmented loan market. And also we have another different type of loans. So for example, we have I-graded loans and leverage loans. So for the I-graded loans, what you can see is that this is unsecured, this is secured, and you can see that this is these are upfront fees, and there's many covenants. This is zero covenants. So the reason because the I grade is most of time is revolvers, right? I talked about, you guys know revolvers. I explained revolvers. Since it's like a credit card type, so the structure of the I grade loan and leverage loan will be different, right? So since the I grade loan is credit card, leverage loan is combination of a credit card and term loans. So you can see that the structure. So for I grade loan is 364 days credit card plus multiple year credit card versus leverage loan is credit card plus term loans, right? So usage, you can see generally undrawn. So sometimes they don't use it. So how many credit cards you have? You may have a lot of credit cards. Do you use every single credit card you have? Maybe not, right? Maybe not. You just put there. Sometimes if you need it, just use it. So you see the usage is also different. And pricing is also different. Upfront fee is also different. Covenant is different. They don't have much covenant because it's credit card. There's less risk, right? But for the term loan, there's a lot of covenants, and also this is so this is a different type of loans. You should understand, and so these are all the background knowledge you should be aware of. You should understand the if you're a bank manager, and you have to decide. Should we go with I-grade or leveraged? If you're Microsoft, you should also make the choice. Should I go I-grade or leverage? If you're investors of Microsoft, you can say, if Microsoft borrow I grade, what does that mean for Microsoft? If Microsoft borrow leverage loan, does that mean Microsoft will do well in the future? All these are the information you should consider when you analyze the loan contract. And also the later part is what we have is we have the leveraged loan. We have the high yield bonds. You see that what's the difference with the bond and the loans? So loan we normally call the private loans, private loans, private lenders. The bond we call it the public loans. So what does that mean? Because for loans, it's only the lender are only come from a small group. So that's why we call it the private. The bond we call it the public. It's because bond, everyone can buy bond. You can buy bond. Connie can buy bond. Zhening can buy bond. Haixin can buy bond. You all can buy bond. So the bond is open to public. That's why we call it public debt. The loan is only open to a small group of people. That's why we call it the private. So you can see the comparison between the leverage the private loan and the high yield the public bond. You can see that different characteristics. You can see that they have a covenants about the pricing. You can about the this is about the bank and investors. This is about investors. This is about the trading. So it has more downside trading. So you can see that they're very similar. They're very similar. So they're similar in what way? They differ in some way. So so you can see that in terms of security, in terms of covenant, in terms of pricing, and in terms of the who are the lenders, and about the tradings. But the whole idea is that the loans are only open to a small group of people. That's why we call it a private debt. And the bond we're open to everybody. So that's why we call it public debt. And then the government will monitoring bond more than the private loans, because if the bond goes bad, it affects a lot of people. If the loan goes bad, it only affects a small group of people. So government have more regulation on the bonds. The government have more regulation on the bonds. So these are the loan contract. Okay, these are the loan contract. So why I'm talking about loan contract here? Because this is very important data source for finance and accounting major to understanding the capital market, So we talk about several things. We talk about what do I mean by lead arranger. So I talk about the revolvers and term loans. We talk about what is floating rate. We talk about the package. What is package? What is facility? We talk about how to make unstructured data structured. We talk about different type of loans, risky loans, safe loans, and we talk about the credit card loans versus leveraged term loans. We talk about the public loans and the private loans. So we talk about all this information. So the bottom line is by understanding all this institutional background, you should be able to understand the loan contract. You should understand the nature of the loan contract, and you should be able to convert the unstructured loan contract to structured loan contract. That's what you should do. And then once the loan contract becomes structured, you can do analytics on that. You can help managers, bank managers. You can help Microsoft. You can help the investors of Microsoft. So that's the bottom line message here. That's the bottom line message here. So so basically that's about the loan contract. So basically, again, going back to my earlier points, you need to understand the nature of the loan contract, the nature of the unstructured and structured data, and how do you use the data to help managers, to help bank managers, to help Microsoft managers, to help investors. So that's the how we can use the data, how we can use the data for, and the structure of the data,